There's a pattern that shows up in financially capable people that doesn't show up in others. It's not lack of knowledge. It's not risk aversion. It's not analysis paralysis in the way it's usually described. It's quieter than that. They model instead of deploy. And because the modeling is sophisticated, because it accounts for risk, timing, and market structure, it feels like capital allocation, but it isn't. What's happening is substitution. Financial analysis replaces financial participation, and because both require intelligence, effort, and discipline, the substitution goes unnoticed. Understanding markets becomes the outcome. Refining thesis becomes the position. The person stays liquid, stays uncommitted, stays ready. But capital that stays ready does not compound. This doesn't happen to people who can't analyze. It happens to people who can. Someone with less financial literacy moves faster by default, not because they're braver, because they don't see the variables. They don't model drawdown scenarios. They don't stress test across rate environments. They don't calculate opportunity cost in 5 dimensions. So they deploy capital. Sometimes they lose it. Sometimes timing is wrong. Sometimes the thesis breaks. But they're positioned. The person who can analyze sees more. And seeing more feels like fiduciary responsibility. If you understand duration risk, liquidity premiums, and path dependency, it feels reckless to deploy without full conviction. So you refine the model. You wait for confirmation. You gather more data. That work is legitimate. It's not procrastination disguised as diligence. It's real competence. But competence applied to perpetual preparation instead of capital formation. Structural gap between understanding an asset class and holding exposure to it. Most people assume that gap closes automatically, that once you understand equity risk premiums, real rates, or volatility regimes, deployment follows. It doesn't. Deployment is a separate function. It has different tolerances, different feedback loops, different psychological costs. Understanding operates in hypothesis space. You can be wrong for years and face no PL consequence. You can refine endlessly with no mark to market. Deployment operates in price discovery. You're wrong within the quarter. The feedback is denominated in basis points. The cost is visible in account balances. So if you're good at analysis, the incentive structure rewards staying there. Not because you're afraid, because that's where your edge is recognized. But edge without exposure produces no return. This is where divergence begins. Once you're known as someone who understands credit markets, tax optimization, or macro positioning, that's what people ask you for. Perspective, framework, thesis, not capital deployment, not position management, not realized gains. You become the person who explains why duration is mispriced, not the person holding bonds when rates turn. That role has status. It has intellectual credibility, but it produces no wealth. And if you believed you were building toward compounding, autonomy, or optionality, this is where the path splits. You don't notice it immediately. You're still informed, still ahead of consensus, still right in conversation. But your net worth doesn't move. Your capital remains in default allocation, cash, passive exposure, employer equity. Not because alternatives are unclear, because clarity doesn't convert itself into position. There is a mechanism worth naming: informational reward. Analysis produces small rewards, a sharper understanding of Fed policy, a better framework for sector rotation, the feeling of seeing what others miss. Your brain registers this as progress, so the urgency to deploy declines. This is why people research REITs for years instead of buying one. Why they model tax loss harvesting instead of executing it. Why they optimize allocation spreadsheets instead of increasing exposure. The mind receives partial satisfaction. Partial satisfaction delays action. This is not procrastination. It's reward substitution. And it disproportionately affects people with high financial literacy. There is also an energy cost to analysis that goes unacknowledged. Deep financial research is metabolically expensive. Parsing filings, building models, tracking correlations across markets. It consumes bandwidth, it creates fatigue, it feels like work, because it is. So when the quarter ends and no capital moved, there is no guilt, because effort occurred. But the effort was analytical, not allocative. No basis was created, no exposure established, no compounding began. Wealth accumulation does not reward internal modeling. It rewards time and market. The system reinforces this trap. If you're articulate about markets, people ask your opinion. If you're credentialed, they assume your insight has value. And it does. But insight and portfolio growth are not the same thing. You can be right about macro for a decade and remain financially flat. You can predict sector outperformance and never own the sector. You can understand tax alpha and never capture it. Markets do not compensate understanding. They compensate exposure. So intelligent people optimize for correctness, for not being wrong publicly, for protecting thesis integrity. That behavior is rational under status-based incentives. But the outcome is wealth stagnation. This explains a frustration common among financially literate people. They're informed, they're prudent, they avoid obvious mistakes, and yet years pass with little change in position. When they observe others accumulating faster, the comparison feels irrational. Because those people aren't smarter, they aren't more sophisticated, they're simply deployed. Deployment creates exposure. Exposure creates returns. Returns create optionality. Analysis alone creates nothing except better analysis. There's another layer. If you can simulate outcomes vividly, your brain experiences partial reward before capital moves. You imagine the real estate deal, the equity recovery, the upside, and vivid imagination satisfies part of the drive to act. Pressure decreases, so nothing executes. This is not weakness. It is cognitive strength misapplied. Capital markets do not recognize simulations. What makes this pattern hard to see is that it looks like prudence. It looks like risk management. It looks like patience. It looks like discipline. Sometimes it is. But preparation has diminishing marginal utility. Beyond a threshold, additional research doesn't reduce risk. It delays compounding. But if you're analytically strong, you believe uncertainty can be eliminated before deployment. Sometimes it can. Often it can't. The cost of that belief is duration, time outside the market, years of foregone exposure. So the capable person becomes more capable, better at modeling, better at diagnosis, better at seeing structure. None of that skill is wasted. But skill without allocation does not build wealth, and the longer capital remains idle, the harder deployment becomes. Because now there is identity. You are the one who understands, the one who sees risk others miss. Deployment means risking that identity, being wrong in public, holding positions through drawdown, allowing reality to contradict your model. For someone rewarded for being right, that is structurally incompatible. This is not intelligence being a disadvantage. It is intelligence being misallocated. The question is not what is the optimal entry. The question is whether you have exposure at all. Analysis cannot answer that. Only participation can. But if you are good at thinking, it is easy to confuse thinking with action, to mistake readiness for movement, to mistake understanding for progress. The person who deploys imperfectly makes mistakes. They miss time entries. They endure volatility. They exit early, but they accumulate basis. They compound, inefficiently, imperfectly. Not because they are better, because they are exposed. The person who waits for certainty makes no mistakes and accumulates nothing. This is not an argument against thinking. It is a description of what happens when analytical competence becomes a structural barrier to wealth. When the skill that built clarity quietly prevents capital deployment. When effort and outcome decouple, and you don't notice, because the effort is real. This channel is not here to motivate you. It exists to make structural patterns visible. If this felt precise, it doesn't mean something is wrong with you. It means you've been responding exactly as the incentives quietly demanded. And once you can see a pattern clearly, you can no longer pretend it isn't shaping your future. That's where capital logic begins.